Hi, I'm Dave Walker, and this is Brian Mattox. We're with Kendall Capital Management. Today we're going to talk to you a little about long-term bonds and investing in general. Long-term bonds are often considered to be the safe or less risky part of an investment portfolio, with stocks or equities being the risky part. That's not always the case. As interest rates rise, bond values will decline, and we've seen that recently, where bond values in 2022 decreased by about 20%, which was actually down more than equities were. And I recently read an article that talked about how long-term bonds, 20 to 30-year treasuries, actually declined 50% from their high at the start of COVID. That 50% decline is equivalent to what stocks did after the tech bubble of 1999-2000. So keep in mind that although bonds provide a part of a portfolio, depending on current interest rate environments, they might not be a good investment for your portfolio. In fact, long-term bonds have not been a good investment for over 10 years, and it's part of the reason Kendall Capital has avoided investing in long-term bonds over this period. Now I'm going to turn this over to my colleague, Brian Mattox, to talk a little bit about what we do like in the current environment.
Thanks, Dave. That's a great point about the long end of the curve. We recently saw that with the regional banks and how they collapsed. I mean, they had bonds on their books that were dropped 50%, like you said, and it forced them under. So conversely, what we do like at Kendall Capital, instead of not the long end of the curve, we do like the short end of the curve. These are the 2-month, 6-month, 2-year treasuries that are paying 4 to 5%. So we'll take that all day long with low duration, low risk, low interest rate sensitivity. So it's a really good place to be right now. We also like equities. We like small and mid cap equities, specifically value and specifically high quality. And within that space, we like active management. Passive management, when you invest in the index, it gives you access to some of those big names, those big AI stocks, those landmines that Clark kind of talks about. So we want to stay away from that. So active management within equities. We also like international. So a lot of the headwinds that we've seen over the past 10 years, they've turned in almost to tailwinds. They've waned. So we like international. We like the valuation relative to the U.S. within the international markets. So again, international is a really good place to be as well. So in short, we like the short end of the curve, which is we can access through our inflation protection portfolio or our low volatility portfolio. We like equities, small and mid cap specifically, which can be accessed to our income and growth and also a GARP portfolio. And we also would throw microcap in there as well. It's another space that we do like. And we like international. And of course, you can access that through our international 60/40 portfolio. So on behalf of Dave and myself, thank you for watching.